All right, guys, we're looking at a few discussions on the use of support and resistance, and I know this is probably a very boring topic to most of you since you're all so advanced and so proficient in your trading. That's just basic, right? We're going to be looking at a few things that hopefully will amplify your understanding and give you a better respect for those things that are lined up with the use of support and resistance. Now, again, it's not to mention you know the obvious basic nature of support and resistance to rub it in your face. It's meant to really bring you back to a core basic tenet to sound technical analysis. There's no better way of gauging the measure of supply and demand and the factors that are inherently tied to price moving up and down, no better than the use of support and resistance. And it's important that you understand that it shouldn't be discounted. Every effective trading plan should at least consider it, even if you are a an EA trader. Okay, if you are a trader that utilizes that type of approach of trading, hopefully you've incorporated some measure of support and resistance in your studies or your EA that is used to do your trading. Obviously, discretionary trading and manual trading is my forte because I think it's the best. There isn't a program out there that I'm convinced that would ever outdo a sound technical analyst, and so someone that has a lot of experience in the study of price. The ability to adjust and adapt to short-term variances in the market environment is completely unique to the human mind, and I don't believe they'll ever come to that level of artificial intelligence because it's a psychological thing. Okay, and it's very difficult to trade that, or rather not trade it, but to code that. And it's about seeing what the psychology is in the market through price action. And it's important that we focus our study on the technical aspects of trading through the study of price action. And there's no better way of doing it than trading with support and resistance. Now, I'm a very firm believer that horizontal support and resistance is absolutely the best in terms of gauging the measure of supply and demand. And I don't have a whole lot of faith in diagonal like trend lines. I don't like seeing up trend lines and down trend lines. I have no faith in them. I can show you many examples of where that looks perfect right out of the textbook, and it looks so easy. Anyone can sit down, just put two swing points together, draw a line, and keep going in time. And eventually, when it comes back down to it, just buy it. Okay, well, it's not that easy. In fact, the professionals, okay, or the specialists out there understand that there's going to be a lot of liquidity based around that simple procedure of trading at a bounce, or the proverbial bounce, okay, at a support diagonal trend line up or down. And I don't see so much of that with horizontal support resistance, and it's based on, like, basically it's like an auction environment. Okay, if price drops down to a certain level, its perceived value will incite buying. Okay, or at least a very slow, a drastic slowdown in the selling, which would cause a pause at least, if not an altogether bounce and turn higher. And obviously the same would be reversed for resistance. But it's important that you understand that if you are an indicator-based trader, I have a special affinity for indicators. While you don't see too many of them on my charts and in my reviews, I believe that it's important that if a trader has the use of an indicator, whether it be an overbought or oversold, whether it be pivots or Fibonacci or something like that, and even moving averages as well, it's important that you understand that price action is the framework that will enable the effectiveness of those tools to be capitalized on. It's not simply put an indicator on there and tell me if it's overbought or oversold, and when it goes oversold, I'm just going to be a buyer. And unfortunately, even when I was a neophyte trader, that's exactly what I thought. I went into the marketplace putting in my indicators, and I thought that's all I had to do. And unfortunately for me, while I did make money, it was unfortunate that I got lulled into believing that I had it licked, and it was just as simple as that. And I was the definition of new money. If you sit down and look at the 90s going into 2000, it was pretty much a proverbial vertical bull market in the commodity market, and everything was just going straight up. So as long as you were buying oversold conditions and buying bullish divergence, okay, that was all I was trading off of. It was just like taking a shotgun and blasting a barrel full of fish. You couldn't lose. But unfortunately, obviously, when the market changed and moved into an trading environment, not a explosive trend following, commercial bull market, where everything was just extrapolated to the upside only, I fell into some problems. And I quickly learned that moving averages and indicators and all that stuff is great, but there has to be a context and a premise behind their use, and it's really framed on the basis of support and resistance. Now, why do you trade support and resistance? And it's important that you understand also that without a framework, okay, to anticipate when supply should come in and when demand should come into the marketplace, think about it. How are we to measure or anticipate that, okay, instead of reacting to it? Because we don't want to chase price. By understanding horizontal support and resistance levels, they will give us a precursor to future probable moves in the marketplace. Okay, so it gives you like a wonderful prognostication value in terms of your chart study. By having an understanding of where support resistance is, basis the asset class that you're trading, and we're going to speak specific to Forex here, but it's completely universal to everything. It's universal to index trading, bonds, currencies, futures, anything that can be traded, even Bitcoin. Not that I'm a Bitcoin trader or even think that anybody in their right mind should be trading that kind of stuff, but it works in that as well. And I'm not trying to rub rub you guys that trade Bitcoin wrong. Okay, I know a couple of you guys just started following me on Twitter. Don't take that as a jab, personal. I just simply don't have any faith in trading Bitcoin. But if you look at the charts, obviously support and resistance, rules that market as well, because it is giving you a visual representation of supply and demand. Okay, resistance providing you a means of supply, and support providing you a means of demand. And looking at where we are in relationship to the supply and demand curve, okay, will give you hopefully the insight that you need to be consistently following a plan, looking for trade setups that aren't just magically popping off at the chart, okay, and saying, oh, look at this, let me react to that. It will give you a framework by utilizing horizontal support and resistance to, number one, know a level in advance. When price gets to that level, have a plan of action to trade when price gets to that level. Okay, and we talk about this concept in specific terms as time and price theory. When price gets to those levels at a specific time of day or day a week, okay, that's a very specific uh, condition that is usually met with a large probability for an anticipatory move higher or lower, respective to the support resistance level that you're looking at. Now, obviously, support resistance is absolutely not a panacea. It's not be all end all, but it does hopefully give you the perspective or framework to look in the marketplace and say, okay, this should be a relatively significant price level, okay, that should provide support. So therefore, when price comes down to that level, there should be a measurable indication of demand, okay, and that asset class should at least pause, and if not, bounce or reverse altogether. Now, obviously, depending upon what the time frame you're looking at, how much it moves away from those levels is contingent upon what the other factors are that we'll discuss in this video set. So understanding that value, okay, or what is deemed as value, okay, is always going to be moving. It's dynamic, okay, and which is the reason why there's multiple levels that would be considered support and resistance based on any time frame. Price is price. It's the same as on a monthly chart or a 1-minute chart, but how we perceive it, okay, and how we measure the supply and demand curve on horizontal support and resistance is obviously going to be, important to you as your development, okay, and understanding how to incorporate support and resistance. We're going to give you some framework on how to look at very generic, specific concepts to frame and flesh out support and resistance on your charts. Now, there will be much more in terms of uh, dynamic support and resistance later on when I start talking about the Inner Circle Trader Market Maker collection, when I start giving out some of the higher level price studies and how to look inside price action. And if you'd like the ICT order blocks that I released in Precision Trading 1 through 3 volume in 2014, then you'll really like the stuff that we talk about later on. But for now, we're going to get really back to the basics of when I came on the scene in 2010, just talking about Forex. I've been teaching obviously since the late 90s, 1997, 98, when I came out of the corner, if you will, and started sharing my insights with everyone on Merck chat and on the internet, AOL. So looking ahead, okay, how can we develop a means of finding consistent trade setups? Well, again, like we talked about just a short moment ago, when we look at support and resistance, we're looking at areas of where we would anticipate a probable bounce or move in price. Without having reference points to deem as support or resistance, you're not going to have any measurable way of determining a consistent approach. Okay, you have to be looking for the same types of thing over and over and over again. Otherwise, you're gambling. Okay, you're looking for a different result doing the same thing over and over again without having a sound plan in place and looking for consistently reoccurring patterns that occur around support and resistance. That's the basis for finding consistent trade setups. And I promise you, if you understand support and resistance, that will give you 80% of the battle won for you all the way, because you're going to be looking for things with an anticipatory mind, not a reactionary mind, not a I'm afraid I'm going to miss the move mind. Okay, in other words, you'll be looking at price, knowing full well that you as the trader, because you can't control price, you can't do anything to steer price, but you can control you, and you're at the driver's seat of your trading. No one can make you do these trades. You are the one that's completely and utterly responsible. So it's important that you understand in clear terms what you do when price gets to these specific price levels. If price trades up to a quote-unquote key resistance level, what specifically are you going to be doing once price gets there? Okay, well, obviously, in a real short list of means of deciding what it is you should be doing when price trades to a resistance level, you should be looking for signs of pausing and or reversing. Okay, and then you want to see a quick move away from that level. You want to see some measurable means of rejection. You want to see price want to get away from that level. And then many times what will happen is it'll try to run back to that level and fail. That's when a lot of our optimal trade entry patterns come in. Harmonic trades, okay, if you're a harmonic trader, you trade bat patterns and butterfly patterns and crab patterns, all those things that exist. If you have the understanding of the support and resistance level in mind ahead of time, when price trades to those levels, that's when you're stalking the pattern. It's not that we're looking for patterns and then looking for a level around that pattern. Okay, you're looking for the pattern to develop at these predetermined price levels, and that's the power of using price action based study, because using support and resistance, it removes all the ambiguity of, well, should I trust the indicator now or should I not trust the indicator? Okay, there's a plethora of all kinds of overbought and oversold indicators. Okay, if overbought and oversold was all there was to it, you would only need one. Why is there so many of them? Because they form fit to make the books and the webinars and workshops and authors money selling that crap. Okay, if you take all that stuff off your chart and just simply look at support and resistance, once you understand how that works, and if you understand this, the simple premise of overbought and oversold, when you looked at price with the tool, then it's obviously, you'll know exactly when you should be following the indicator then. But then it becomes a question of, is there any value in the indicator? Okay, and that's arguable. I like indicators because it gives me a like a sentiment indicator based view on what I think the neophyte traders are going to be expecting. And if I'm coming down to a support level and I see folks seeing a small little bounce off that support level and it goes overbought, they're going to look to sell that because it's overbought. And I'm going to be looking for the small retracement, go back down into that support level, and I'm going to be buying it. Okay, and that's many times why neophyte traders get caught up, selling lows and buying highs, and that's because indicators will do that to you every single time. So now, what does support resistance tell us as traders specifically? Obviously, we know that resistance provides us a means of supply, and support provides a means of graphically depicting demand. So when we understand that graphically, okay, when price runs into a resistance level as it rallies up, okay, that is indicative of more sellers than buyers, okay, and a lack of buyers, okay. And when price comes down to a support level, that's an indication of strong buyers or a lack of sellers, okay. So understanding that simple premise, okay, if you look at higher time frame price charts like monthly, weekly, and daily, there's absolutely no reason why you can't carve out a really, really nice return over an annual basis and not even really trade a whole lot. But the problem is much like myself, we are looking for action. We want to get in there and we want to be doing something because it doesn't seem productive until we actually put trades on. Think about it. We don't know how much money we're going to make. Most of you don't know how much you're going to lose because you don't either trade with a stop or you trade with a mental stop. Okay, you think that you know where it's going to probably go, and you'll be willing to assume that loss if it goes there, but many times it blows right through that, and then that mental stop does exactly what it's called. It makes you mental because you wish you would have had a hard stop in there. You, by having understanding of support and resistance, will know exactly where your stop loss should be, and also where everyone else's stop loss is as well, even the fund managers. That's right, the fund managers. They're going to put their stop loss in there just like everyone else does. And that's why the specialists and the market makers exactly scoop up those liquidity pools where there's a pocket of orders resting just above an old high or just below an old low. And it's uncanny how many times that takes place. And if you understand where the market's going on a macro level, okay, and if you find a support level, when price is coming down to that level, okay, don't assume that it's going to stop right on that level. Many times what will happen, it's going to dip below that level. Why? Because there's going to be existing pending orders below that level that's going to become immediate market orders, okay, and they're going to be used to provide liquidity for those participants in the marketplace that want to take the other side. And that's, if you look at all of your losing trades, that's probably 99.99999% of how you lost in the marketplace. Your stock got taken, and then the move you thought was going to happen took off and did it, okay. And there's no secret to it, okay. Everyone knows that the textbooks tell us to put your stop loss right below an old low, the most recent low, okay. And it's common sense. It just takes a very small measure of static price action to come down there and just tag that out. If a big order comes in the marketplace and it needs liquidity to be executed, market maker is going to take the market to that level, okay, and fill that order, knowing by that one trade printing, okay, once that trade becomes a market print where that price is now there, every order around that particular level goes hot. In other words, everything becomes a market order. All pending orders, buy stops, and limit orders all become market orders immediately, right then and there. And market orders are what? That's candy for the market maker. That means he's going to get whatever fill he wants. Okay, and that's what they're doing in the marketplace. And I know that's probably going to be, probably a little bit uncomfortable for some of you if you're just new to understanding how this stuff works. And you may be questioning, well, why should I be doing this if there's people out there trying to take me out of the marketplace? Well, when you understand what they do and how they do it, you can do what they do in your trading and ride their coattails. That's the basis of consistent trading. Knowing what the smart money is doing, who the real smart money is, not the guys that are talking on the forums that think they know who smart money is. Most of them don't. Okay, and I have dealt with people on an institutional level. I have been in an institutional level environment, and I have seen a lot of the things that I'm sharing now, and most of the folks that have known me for a long period of time aren't real happy about me sharing this stuff. And I don't care, because I like doing it, and I always said once I got to the point where I knew what I was doing and I was comfortable with it and I didn't need any more money, boom, I would share it, and this is what I'm doing. I'm never selling it, so I get a lot of gratification for just being helpful to the general populace. Now, it's not enough simply knowing what support resistance levels are, on your charts, but we want to be able to gauge the strength of those particular price levels. And when we look at price, you want to see resistance levels being taken out and support levels being respected. Okay, and that is a really good bullish environment. If we see support levels being taken out and resistance levels being respected, that is a very bearish indication. By having that mindset in your trading, it's rather simple if you think about it. It's very simple. But how many times are you actually looking at price that way? You're looking for everything to be extremely difficult. You want to make it so complicated that it's sexy. Okay, that way you can tell your friends and they can say, "What? That doesn't make any sense to me, because that's too advanced for my mind. I'm not gonna be a trader because it seems too complicated." Trading really itself is easy, and the problem is we like to make it harder, because simply saying it's gone low enough to a level it's probably going to go up from that point, if we just buy there, look to take a small profit and control our risk, that's all trading is. Now, unfortunately, again, like we mentioned earlier, everyone that comes into the marketplace wants to trade a lot, thinking that more trading equates to more success, and that's absolutely not the case. That's not the case at all. You'll find that many of the most significantly profitable traders out there are those that are ones that do not trade a whole lot, okay, that are very selective, okay, very quote unquote cherry picking, if you will. The understanding that if you have a system, okay, and there's a recurring theme that comes out of most technical circles, that if you have a system, you got to take every signal. I don't take every signal. Even in my own methods, I don't do that, because I'm a discretionary trader. I know by looking at price action when the setups look like they're there, but the probabilities aren't as strong as other times. Okay, and that comes with experience. You can't learn that from a book. You can't go to a workshop and learn that. That comes from years and years and years of digging your nose into price action and studying it and seeing your real trades pan out, taking the losing trades, taking the winning trades, taking the scratch trades, break evens, marginal losses, marginal wins, and digesting price action and seeing these reoccurring seasonal tendencies, these reoccurring general patterns that come into the marketplace all the time, that are just generically inherent to repeating over and over and over again certain periods of time throughout the year, throughout the months, specific months, certain days of the week. All of these phenomenon, okay, are at the disposal of a specialist, and I'm something of a specialist because I understand specifically certain times of the week, times of the year, times of specific months, and times of the days where certain things are coming into effect, where I know that smart money will be doing a specific type of thing and I can capitalize on that. I'm not trying to go out there to hurt anyone, but I am going out there to try to take the other side of less informed traders, and I don't feel that is warranting an apology. Okay, because we all sign the risk disclosures when we come into this business, and if you don't learn from your losing trades, you aren't going to learn from the experiences of losing, because you're just going to be caught up in the pain factor. And that's usually the loser cycle. You go into this business and you have no framework, no basis of understanding where the trades are going to form or when to anticipate them. And support and resistance gives you that. There's no better tool at a trader's disposal than support and resistance. It's absolutely crucial. In terms of my opinion on trading technically, that's it. That's the secret. Understanding of where support and resistance is, that'll give you like I said, it's 80% of the battle beaten right there, because you won't be trading out there in empty space, okay, between key levels, okay. There are ways of trading. Don't get me wrong. There are ways of trading that stuff, but you're still going to be referencing smaller time frame key support resistance levels with a directional premise based on those higher time frame levels. So you're still going to incorporate support and resistance, but if you focus on monthly, weekly, and daily levels, there's absolutely no reason why the average Joe trader can't find a few trades a year to be net profitable. So now what types of support and resistance are there? Well, there are two types of support and resistance, and in my own understanding, okay, I dub them as natural support and resistance levels and implied support and resistance levels. Now, what is a natural support and resistance level? One would be obviously a 12-month high or low, and that would be the range, the highest price in the last 12 months and the lowest price in the last 12 months. That are there are basically your 52-week highs and lows. Okay, pretty standard, levels in all of the technical circles. If you're a stock trader, those are real important levels. You have quarterly highs and lows. That means every 3 months throughout the calendar year, okay, there are specific highs and lows in the last 3 months. Okay, you want to make note of that. Those levels are very, very crucial. I love those levels more than any other level because they give me the framework on how the commercial traders, which we'll talk about later in this video, how they move in and out of the marketplace, and they hedge, and they provide the liquidity to move price around like it does. Okay, and a lot of people will argue and say, it's not the commercials moving price. I'm going to tell you right now, it is the commercial traders, it is the large institutions, it is the banks, okay, that move price to levels of disparity. In other words, they go too far away from equilibrium, okay, and that's where opportunity is. You want to see price be pulled to these levels, okay, and every quarter there's a specific, tug of war that takes place where price has gone too far higher than they should have and too far lower than they should have, and then there's an opportunity when you trade at these extreme levels. You have monthly highs and lows as well, which is basically the 4-week range, most highest high and lowest low in those 4-week range. Basically, if you just look at your trading platform, just mark out the previous month's high and low, boom, you got it. You have weekly highs and lows, okay, the previous week's high and low, and I like to look at least 2 or 3 weeks worth. If I'm looking at weekly ranges, I like to look at that because every swing point is going to be made with 3 candles, okay, whether it be a monthly chart, weekly chart, daily chart, doesn't matter. Every swing high and low is going to be seen with at least 3 candles, okay. So I like to look with a background of at least 3 candles in perspective. Even though I'm looking at weekly highs and lows, I'm still referencing at least 3. The previous week's high and low are very sensitive as well. Now we have the daily highs and lows, obviously the previous 24-hour range. Then we have session highs and lows. That would be the highest high and lowest low during the Asian session, the highest high and the lowest low during the London session, and the highest high and lowest low of the New York session. There's also intraday fractals, okay, that you could be looking for that gives you your support and resistance. And that's a lot of times based with range trading and pattern trading. And then obviously the least of all of importance to me is trend line analysis, channels, and support and supply and demand lines. They, to me, if it's not horizontal driven, I'm not interested. So if there's anyone that is looking for me to talk about trend lines, okay, diagonal up and down, or Tom DeMark trend lines, because yes, I read the book, New Science and Technical Analysis when it first came out. I had the first print edition, and I'm sorry, I just don't see any value in it. And I have other tools that give me a lot more indication before those Tom DeMark trend lines break. I already know what is most likely going to happen, and I'm usually in there before the trend line break, and that's usually what professionals are doing. They're getting in there before the move takes place. That's the basis of what we're doing. We want to be in there before the markets are moving, and trend lines just unfortunately are just too late to the party. Now, implied support resistance levels are things like Fibonacci levels, okay, retracements and extensions, pivot points, okay, monthly pivots, weekly pivots, daily pivots. And by having those levels, okay, you have they don't work by themselves. There's no magic to them, okay, but when you incorporate the natural support and resistance levels with implied support and resistance level concepts like Fibonacci and pivots, it's it's mind-blowing how powerful the setups are when you have those coupling or these confluences of both forms of support and resistance. Now, obviously, when we talked about 12-month highs and lows, this is just a real quick graphic depiction of looking at 1997. You can see how price, when we traded back up to that same general area in 2006, price was really giving you opportunities to find sell signals in there. Now, obviously, there's no guarantee that price is going to return to those levels, stop on a dime, not go through it just a little bit. It might go through just a lot more than you probably think it will, obviously, but then the patterns that exist at these levels, you would be looking for sell scenarios, bearish divergence, optimal trade entry sell signals, bearish bats, bearish butterflies, bearish crabs, everything that you would look for on a bearish level. Okay, turtle soups. Okay, this is really actually giving you a turtle soup setup where turtle soup is just a false breakout, and it moved above the 1997 high. And then it quickly rejected and moved a considerable amount of pips lower. Now, it did return back to that 240 level, but it still moved a significant means of price movement in terms of pips. And that's really all you're looking for. You're looking for scenarios that give you high odds setups. Now, obviously, 12-month highs and lows, they don't really set up a whole lot, okay? But they're significant price levels you have to be aware of. We talked about earlier, one of the ones I really enjoy looking for and doing a lot of my studies with is the quarterly highs and lows. And you can see here the price on this example showed how price came down to just briefly blew through the previous low made in this sample size of data. During the month of April, the low was formed there. During June, it came down to that level, swept it just a little bit, and look at the reaction after that. Explosive to the upside. Now, what we're going to talk about is when it makes that lower low in June comparable to the low that was made in April. When we look at that phenomenon taking place there's a pattern that we're going to be looking for that helps us measure the institutional sponsorship behind specific types of moves like that. And you'll clearly see that these things are not in any way, shape, or form indicative of continuation going lower. And in fact, they're many times accumulation patterns. Obviously, monthly highs and lows, it's not rocket science. You can see that, look at just many examples here, trading old monthly highs and lows. Okay, just simply looking at the old monthly highs and lows, drawing your lines on them, and waiting for price to get to them. There's a lot of opportunities just using this example, okay, where you could do swing trades and do just a small handful a year and carve out an absolutely stunning return, and not even have to be trading full time. You could be doing your 9-to-5 desk jockey job, your average Joe, going to work, come home, and see what you've done in the marketplace. You can do end of day type of trading with monthly highs and lows. It's simply sitting down at your charts, putting the lines in, waiting for price to get to those levels. You can use a cell phone to alert you when price trades at those, and then simply just pull it up real quick. You can take yourself to the bathroom at work, pull up your intraday price action software that you would be able to use on your smartphone. And if you don't have a smartphone and you're looking to trade forex, you got to get with the program and get caught up, because it's an invaluable tool, because you can actually do a lot of intraday trading while you're at work. I'm not saying cheat your boss and sit in front of your phone all day, but it only takes a few minutes. Once your alerts tell you that prices reached these specific levels, you can say, okay, well, we went up to a specific level at 106.70, and I think that price is probably going to be bearish there. And if price sells off a little bit, that's indicative of what we're looking for. If it trades back up to a specific level that doesn't meet that same price level, in other words, a failure swing or optimal trade entry sell, you can put your limit order right there, and then there you go. Your known stop loss would be in place. You can put your limit order for entry and your take profits, and just simply let it go on autopilot. And again, you can trade monthly highs and lows with a day job, and it's wonderful how many opportunities to set up over just a small sample set of pairs. Weekly highs and lows, same scenario. You don't need to be trading full time sitting in front of a chart to trade weekly highs and lows. You can see the example here where price comes down for the euro yen, explosive move, just coming right back down to an old low, just an old low. Previous week low, bang, explodes to the upside. Huge move. That's 300 pips, okay, and that's all inside of a short span of time. Again, as a swing trader, working off the idea of working at a job and not having to be able to sit in front of your charts, and maybe you're a developing trader and that's how you're going to have to start. Weekly highs and lows, much like we did with the quarterly and monthly, are absolutely phenomenal levels to be keying up on. All right, now the daily highs and lows, obviously you can still reference that if you are a part-time trader or one that is unable to be in front of the charts every single day. But previous days highs and lows are really the wonderful setups that day traders can use, because the banks are looking at these levels, and I like to look at at least 3 days worth of data. In other words, I'm looking at today and the previous 2 days before it, sometimes maybe a day before that, but I'm looking for at least 3 days worth of data, okay, to see where key highs and lows are, and I can look for rejections at these specific levels and anticipate price patterns forming if they line up with specific times of the day, like New York session open and London session open. Now, obviously, in greater detail, the Asian session highs and lows are really beneficial, especially if you're a London trader and New York trader. And again, this is now speaking specific to those individuals that are day traders or short-term scalpers, because these price levels are highly sensitive on an intraday basis. You can catch many times 10, 15, 20, 30 pips at intraday basis by utilizing the Asian session high and low. I adopted a style of the Asian range that was taught through Chris Lorry's work. That's really where I learned the Asian range from. I tweaked it a little bit. He has a little bit of a different time window. It's not much, but I just incorporated the way I used price action in the Globex S&P 500 market, and that's basically using the midnight time frame of New York. That's my beginning basis of the new day, and that's where I end the latter parameter for the Asian session. So even though it states here that 4 a.m. and these times that you see here, beginning and ending, these are going to be New York times. And unfortunately, I tried to consider all of the possible ideal scenarios how I can teach this in a way where everybody all around the world, because there's a lot of people that follow me in different parts of the world, I'm not going to go into trying to make sure that the times are lining up for you. Okay, so the way you're going to learn the easiest from me is understand that I live on the East Coast of North America. So basically, whatever time it is in New York, that's what time I'm in. So every time I'm talking about specific times, 90% of the time I'm referring to my local time. And it's easier for you to just get yourself a cheap watch and set it to New York time, and just have that when you're watching my videos or watching this type of information and looking at your charts, because then you'll know what I'm doing and what I'm expecting based on that idea. Obviously, that's in the same vein that we talked about with the Asian session, the London session highs and lows. Now, London session highs and lows are going to be very influential in terms of your New York trading. If you're a New York intraday trader, in other words, if you start your trading, okay, a lot of people can't get up during the London session. I don't know why. There's a lot of money to be made, and it's absolutely the best entries for the daily range if you're going to be trading it. Obviously in the London session, but I understand there's a lot of people that just can't do it because of time constraints and family commitments and maybe even jobs. But if you're going to be a New York session trader, you have to at least reference the London session highs and lows, because they're going to be paramount to the swings that set up during the New York session. If you do not understand London session highs and lows, just take a couple weeks and go through the previous data on your platform, mark those out, and see what trade set up during the New York session time frame on an intraday basis and how many pips are available just by incorporating those specific price points, and you'll be absolutely astonished. And obviously the New York session highs and lows will be influential for the new Asian session that starts up. Okay, so the calendar that follows the sun around the globe here in the planet Earth and the investment world, trading day, whatever session highs and lows form in the New York session, okay, are going to be influential during the Asian session. Okay, so the Asian session requires and references the New York session and the previous London session, highs and lows, and New York session references the previous London session and Asian session. So you're always looking back at least 2 sessions before the trading session that you're trading now. By having that, it gives you all of the intraday fractals, okay, that are most likely going to be influential in terms of support and resistance on an intraday basis. And like we just said, intraday fractals, highs and lows, are going to be, swings that form and retrace back into previous session highs and lows. And by understanding that concept of intraday range and where we're at in terms of directional premise for the high or low forming for that particular day, they're going to give you a framework to at least look for trading scenarios to get in sync with momentum, or maybe even take profits as price reaches up to these old levels. That may be a good indication to take your profits. Now, institutional price levels are ones that we like to follow, and they're very simple, okay? And honestly, as a new trader, this is where I tell everybody to start with. If you simply look at the 100-point levels, in other words, for instance, you're looking at the British pound USD pair here as a sample set. If you mark off the 160 level and you mark off the 161 level, which doesn't appear on this chart, okay, they would be your 100 levels, okay, or big figure levels. In between, halfway between that, is a 50 pip mark, okay? In other words, it would be 159.50 level, okay? That's your mid figure level. In between the big figure 160 and 159.50, okay, we look for the 159.80 level, okay? And in between 159.50 and 159 even big figure level, we look for the 159.20. Now, in summary, we're looking for the 00 levels, the 80 levels, the 50 levels, and the 20 levels. And then obviously the lower 00 level again. And this goes across the price action that you're trading around now. And what I do is I look at about a 300 pip range based on where we're ever at trading at market. And I go up 300 pips and I go down 300 pips. And I look at those price levels. If you do that as a beginning neophyte trader, and you say you're questioning your prowess as being able to identify support and resistance levels, or maybe you can't be in front of the charts all the time, and you just want a real quick, clean approach to support and resistance, this is it. Okay, this is the one you're looking for, because there will be enough trading patterns to form over the course of a month that if you aren't able to trade every single day as a day trader, not that you should trade every day, but if you're not able to do that, be in front of the charts every single day, by using these types of levels and looking at the higher monthly, weekly, and daily, you'll find trade setups. They'll be there. The ability to remove the uncertainty or the emotional charge that comes with how many levels, how many lines should I have on my chart? Take all that out of the equation and just simply say, okay, I'm going to be looking at the big figures, 00 levels, the mid figures, the 50 levels, the 80 levels, and the 20 levels. And the reason why these levels are so significant is because institutional traders, many times their order blocks are around these particular price levels. That's why it's uncanny how price goes to these particular levels. The banks are taking action and providing liquidity for traders at these price points. Citibank is not having a trade out there with 159.17. That's not their order. That's not their block. Okay, they will have 159.20. They will have 159 evens. They will have 159.50. Okay, those levels are why many times you'll see what you think is a short-term support resistance level that may be at a weird off the wall number. Many times price will go beyond that just by a little bit, but go right to one of these levels and then turn around and go the other way. But if you're just looking at what you think as a short-term support resistance level, it may not be enough. Okay, so for now, just understand that these levels are very, very psychologically sensitive, okay, because there's a real world business need, okay, that's facilitated around these price levels, and it's based on institutional trading. We're going to talk a little bit more, obviously, as we go further about support and resistance, but right now, you absolutely have no excuse now. Zero excuses why you can't have your charts properly lined up for support and resistance scenarios. there's a lot of types of support resistance that are made available to you, and when price gets to these price levels, what you're going to be looking for is your pattern. You may be simply a overbought divergence trader, but if you trade up into a resistance level based on the way we defined it in the previous slides here, that, okay, is going to be the framework for you to engage price, to get an experience with price, of understanding how price reacts at these levels, looking at how your indicator based analysis works and or doesn't work. You're going to hone your anticipatory skills. And again, it's not important that you make money initially. You want to learn how price behaves when price gets to these levels. Many times you're going to think that price should absolutely turn on a dime, and it won't do it. It'll go through it and blow through it. Actually, you'll learn more from those environments than you will from when the trades actually work out. Okay, and it sounds you know, like an oxymoron, but you really do learn from the times that it doesn't work out for you. And what it does is also it desensitizes you, okay, from when you see it not working, and then when you actually eventually start trading with real money and trading with live funds, you'll understand that your trade, simply because it's worked 8 times out of the last 10, it doesn't always equate to 80% accuracy. You're going to have that future existence of a string of losses, okay? And it doesn't make a difference how, and that's why I don't like to preach too hard about consistency in terms of percentage, because it doesn't make any difference. You can make an extremely large amount of money and be 40% profitable. You can have a win rate of 30%, 30% of the time trading, and make millions and millions and millions of dollars. Now, fortunately, I've traded with a lot higher percentage than that. Obviously, I've been trading for 2 decades, but you don't need a higher percentage rate, okay, to make a lot of money. You need to have a consistency rate that's high, okay, of doing the same thing over and over and over again. But in time, you'll have a selective process that will, yes, your quote unquote method or system says there's a likely trade sitting there, but you'll also have a worldly knowledge that says, you know what, it looks like it, but I'm going to wait for the next scenario that does this or that. Okay, and that might fly in, again, in the face of those that are out there saying, well, that's wrong because you need to take every single signal. And it's like this. I've been doing it for 2 decades, and I made a lot of money, an obscene amount of money, and I'm telling you what works. And 90% of everything I'm telling you isn't in books, and that tells you something. If the guys that are selling you these methods and systems and courses and stuff tell you you have to take every signal or you're going to miss that next winning trade, I get enough winning trades, and my losses are small enough that I don't care about missing the ones that I didn't take and still paying out. I don't care about them, because you're going to see that there's a generic method of trading that you're going to be in line with the professional perspective, and by default you will see money move into your account. Think about that. By default, by no effort of your own, okay, except for the execution of your orders, there's going to be no effort of your own that results in you making that money. See, the guys that do these system, beating their chest saying you have to take every single signal, okay, or you're not following the system. I'm following my system. I'm following my method. It's discretionary, and that's the people that make money. If you look at system traders that trade every single trade, that's why their percentage is hurt, because they take every single trade. They don't learn to anticipate when price action is really favored to move in a specific direction or another. Okay, and it comes with the understanding of market tone, or risk on risk off scenario. Okay, understanding what the general market's doing. Okay, and they get too much complacency, okay, about trusting the system and not learning to be a very sensitive price action trader. I can see many times turns in the market tide before they actually are clearly discernible on the chart. And when I sit with people in live sessions and they see that, it blows them away, because I'm not relying on anything outside of my own understanding of price action. And it's not going to be found in books. You're not going to get that, but you will get it by using these things that we're teaching in these videos, by skill sets and drills and exercises that force you to look at price with very specific laser guided perspectives. Okay, specific segments of price action, certain times of the day, certain times of the year, certain specific months. Okay, there's a thing that that repeats itself over and over and over again, but systems don't see that. Okay, EAs don't see that. They just want to catch the next minor aberration in price, and I don't care about that. I want to see when uh, you know UBS is coming in with a large block of orders. Okay, that's what I want to see. Yeah, and that's what moves price. Huge institutional order flow, not rinky-dink little indicator-based EA stuff. Okay, that doesn't make any sense whatsoever. It's mathematically derived, and I have no faith in all that stuff. I do have faith in understanding what price has done on the left side of my chart and what that indicates in terms of institutional sponsorship. When you understand that, everything else is secondary. You want to have institutional sponsorship in your trading, and what we're going to be covering in here will help you do that as well. Alright guys, we're going to be talking about the COT analysis concept, okay, or commitment of traders. Now before I get into this, you got to understand that a lot of the stuff that I teach, okay, of core principles that I have, actually derived from Larry Williams, and he's obviously, pretty well-known guy around the world. It's interesting that if you research him, he's actually on YouTube and in a couple different videos. Not that he published them; other people are like sharing them. But he was doing a keynote speaking engagement where he was talking to individuals about specific types of trading asset classes and such, and how he's settled on futures. And I used to be a futures trader, but I segued out of futures and moved into forex because I do believe it's the best asset class right now. It could change because of things down the road we don't know about, but as it is right now, I think forex is, because you can tailor risk parameters like no other. You can't do this in stocks. You can't do it in commodities, because commodities you have specific asset. You have specific contract specifications that you have to work within. Forex, you can trade for as little as 1 cent per pip. Not that you could do a whole lot with that, but as a developing learning trader, that's a wonderful thing. And you can't learn outside of paper trading the commodity market, without trading a mid-am contract. You're stuck either trading a full lot or a half a lot. And if you don't have the capital to be able to do that, you're pretty much out of the game. I'm referring to Larry Williams, he was probably the first person on the planet that put commitment of traders on the map, okay, and why it's important. And the CFTC requires the large traders that have reportable sizes in their trading, they have to, on a weekly basis now, divulge, whether they're buying or selling on a net basis. And that's a wonderful insight to have, and I hope they never change that transparency, because it gives us an x-ray view of real institutional sponsorship on a macro level. And what you're going to see here as it relates to commitment of traders is nothing more than what I learned back in 1990s from Larry Williams, okay? And it's still wonderful. He was using the same stuff in the 1970s and made millions of dollars doing it then, and his stuff still works and makes millions of dollars now. So if you haven't considered the commitment of traders and you're a forex trader, you're pretty much cheating yourself, because it's a wonderful resource to have. But what is commitment of traders? And really what it is you're looking at three groups. Okay, three groups of traders. You have the small speculators, which is kind of like us. We're people that aren't trading with an astronomical level of contracts in the futures market. Obviously, most of you, if not all of you, are watching this. You're forex traders, and we don't trade in contracts. We trade in lots. We would still be grouped in what we consider the small speculators category. There's a second group called the large speculators, and they're usually the large hedge fund traders. Okay, and 90% of the time they're right in the trending environment. Okay, where they get hurt is when the trend reverses and goes the other way, and that's okay. They're okay with taking that. Institutional funds are predominantly trend following in nature. They're momentum type traders. They understand the large ebb and flow on the macro level, and they are able to ride that stuff out because of their risk parameters and their risk models that are adopted for that type of trading. The third category of traders for the commitment traders data is the commercials. Now the commercials are grouped in two categories. You have a commercial user and you have a commercial supplier. Okay, and a perfect example of that would be like cocoa. Cocoa is used to make chocolate, and there are mass commercial growers of cocoa, and then there's mass corporate users of cocoa like Hershey and Nestle, and anything else that would be a large commercial entity that uses cocoa for chocolate producing. They have a real close tie to fundamental supply and demand factors as it relates to cocoa. Okay, and don't let me confuse you. We're not talking about commodity markets as as the soft, but we're talking about the supply and demand equation and how it's discernible through the utilization of the COT data. The commercial traders, whether they're either a supplier or a commercial user, they both have very sensitive ears and eyes, closely watching the fundamentals, okay, of cocoa. That's not anything different from a commodity, okay, like corn or wheat or gold or crude oil, okay, and same thing with a currency, okay. Banks are watching the supply and demand for a specific country's currency. By following these individuals that have a lot more people, okay, that their job is primarily just simply to watch the fundamental basis of, is it under a large level of demand or waning demand, or is there a large supply coming in the marketplace? Okay, there's trained accredited staffs for these large commercial users that are staffed just to do that very thing, to watch the fundamental drivers in that specific asset. Well, think about it. If we are able to watch that same phenomenon take place for like the Swiss franc or the Japanese yen or the Canadian dollar or the British pound or the Australian dollar, that is astronomical in terms of weeding out a huge amount of fundamental data. I'm not a fundamental driven trader, but if you hold me to the aspect of, do I use fundamentals, I'd have to say yes, because it's based on this stuff right here. You can't get more fundamental than the commitment traders, because they are the ones that provide the liquidity that makes the markets move like they do. Okay, it's these entities on the other side, okay, of the trading world. They are the ones that propel price up and down. It's not the retail traders. It's not the large funds. They are, if you look at this chart, the heavy dark line is the commercial traders, and if you look at the medium thickness line, okay, if you look at that, they're generally diametrically opposed to one another. When the heavy thick line is making a peak, okay, making a real higher high, that lesser thickness or large speculator line, it's making a lower low comparable to the commercials. So there's a diametrically opposed position between the two. When the commercials change gears and start coming down from a high, okay, you'll see the funds, okay, or large speculators, they'll start to come up, okay, and they're always moving back and forth until they reach an extreme reading on a diametrically opposed basis. When you see the diametrically opposed scenario where they're really, really high in the commercials and the large speculators are really, really, really low, okay, what it's suggesting is that the commercials are net long, heavily net long, while the speculators on the large scale, or fund managers, okay, are extremely bearish. Okay, usually when you see that scenario and it's a 12-month or 4-year extreme reading, in other words, if the commercials have the highest reading in net longs in the last 12 months to 4 years, okay, those are the two benchmark measurements I like to look at. One 12-month calendar year, okay, what's the highest and lowest they've had in terms of net long and net short positions. When we violate a 12-month high or low, that's significant. That's usually a trend changing environment. If we look at over a 4-year span, okay, they're really indicative of a major tide change, and it's important that you understand that. We're going to be looking at an example of that with the Canadian dollar and recent price action and analysis that I shared on the internet and with Chris Laurie's group in his Pro Traders Club. But what is a commitment traders report? Well, it's basically a breakdown of the total longs and total shorts, and then by comparing the two, you're getting a net position of net long or net short position. Okay, what we like to look at are the measurements of the long or short positions of the commercials, ideally, okay, because they are quote unquote the smart money, and then the large speculators. Okay, those two camps are the one where we do not look at the small traders, because the average Joe, if you look at what's going on, they're 90% of the time wrong. They don't know what they're doing. But if you look at the commercials and you look at the large speculators, okay, those two camps are basically taking the other side of each trade. Okay, in other words, as the commercials are putting their positions into the marketplace, we're going to give a graphic depiction of what that looks like. The large speculators are usually assuming the other side of that trade. And in trending environments, it's profitable for both. And you'll see that as we move along. But we do not consider the small traders at all, because they're the less informed, or what we consider the street money. All right, so again, we're focusing on the large speculators because those individuals are going to be trend following in nature. And that's going to be very, very important, because if we are looking for institutional level types of trades, okay, and we're looking for a directional premise in our trades, it's going to be arrived by looking at the relationships between the large commercial traders and the large speculators, because the large speculators are trend following. They have a really good track record of being right during the long trends. Again, their pain comes in at the major extremes, highs and lows, and they don't care about picking tops and bottoms, and you shouldn't either. Okay, and what this is really going to help you focus in on is trading during that lion's portion of the big moves, and not trying to be so fixated on trying to get the high and the lowest low. We don't need that. In fact, I don't even try to trade that. I used to do that kind of stuff, and I got probably lucky 2 times in getting a high and a low in a market. But outside of that, you think in 20 years I'd be able to do better than that, and it just simply doesn't happen. But I can trade really, really high near the highs on a bear market. Okay, as we have retracements in a bear market, I'll sell right near, very close, if not sometimes the very pips of the highs in bear markets, because I understand the dynamic of that. But I'm not trying to pick the tops. As in a bull market, I'm not trying to pick the tops. I'm looking for some clear indication of a reversal before I start going in there and expecting a breakdown. And there's tools that we use to help gauge that. They're not 100% of the time accurate, okay, but you don't need 100% of the time accurate. But when we do see things in line with a measurable, sustainable macro trend based on these two camps, large speculators and commercials, you're going to see that it's astronomical in terms of probability. So the superstars that we really want to be focusing on as a fundamental insider are the commercials, and where their net long and net short positions and extremes over the last 12 months and 4 years is absolutely crucial, because if they're extremely bullish net long, higher than they have been in the last 12 months, and really more importantly, if they've done it most recently in the last 4 years at the most highest they've ever been, that is a major low forming, and you could really avoid a lot of unnecessary losses by being a continuation trend follower in a bear market, because that's what would be going on as they get that net long extreme position. The market will be dropping, okay, and because as it's dropping, they're hedging, so they're going to enter the moves, and we'll talk a lot more in detail about this, but they price in the low. Okay, when they no longer are buying, okay, and they're going to start distributing, that is going to facilitate the trend change that takes place, and the large speculators again start to unwind their shorts and then start to reaccumulate long positions as the commercials now start to sell that and provide the liquidity to the large speculators. So we really may be focusing on the trend, the macro trend of the ebb and flow of net long and net short positions of the commercials, and gauge that with the overall price action on a monthly and weekly basis. And that's going to give us a huge amount of insight in terms of prognostication and future direction. Now, what does a 12-month extreme net long position and a 12-month extreme net short position look like? Well, when we look at a commitment of traders report graph, okay, there's a zero basis line, okay, and that's going to be depicted by this heavy thick line here. And Above that heavy black line, we have it showing a color of green. Okay, not that the commitment traders is colored, but I'm trying to give you an idea of what it looks like, conceptually. Above the zero line, okay, and we're only looking at the commercials as it relates to the COT data. We're not looking at the net long and net shorts of the speculators, small speculators or large speculators. We're just specifically looking at the commercials. Above that black line or zero basis line is what would be considered net long. Okay, in other words, they're bullish. They may have a large number of short positions on, but as a net basis, they have more longs on than they do shorts. So again, we have to understand that commercials are both hedgers and producers. So they're going to always be doing a business transaction always in the marketplace. But if they're extreme levels, net long and net short, okay, think about it, because they're greedy just like us. They're trying to save money and they're trying to make a profit. Okay, otherwise, why are they in business? They're not in business for the fun of it. They want to have a net gain and profit. So if they're net long, okay, the highest they've been in the last 12 months, we would be expecting a major bottom to be forming. An extreme net short, okay, basically all you're doing is looking back over the last 12 months. You're looking for the lowest reading they've had, and you can see in this crude example, during the period of July and August, they had a net short position. Okay, but look what they did in October. That's the lowest they've had in terms of the last 12 months. They had a net short position in May, and probably what will be considered the previous year in December, they were net short as well. But this is a graphic depiction, okay, not based on any real data. I'm just showing you the concept that in October, this would represent a net short position extreme reading over the last 12 months in October. So there would be a major high or top to be formed in that particular time period. Now, looking at the trend changes like this, it provides you an X-ray view, if you will, to anticipate reversal patterns. Not to bet the farm on them, thinking, okay, it would be great if I see this data and if Michael says it's working and it does really well, and Larry's made millions of dollars and Michael's made millions of dollars and XYZ traders made millions of dollars doing this. Let's just say that the Australian dollar gives a net short position extreme. It doesn't mean go out there and bet the farm and over leverage your account and looking for sell scenarios. Okay, there's things that you have to look for in price action to justify the expectation that a reversal is underway. Okay, and if we look back at risk to reward ratios, okay, and managing equity and risk, if you are a 2% risk trader, typically, and that's your maximum risk, in environments where you're expecting major turns in reversals of long-term trends, those are the times when you would be risking less than half of your normal trade position size. So if you're risking 2%, risk about 0.75% or 0.5, or in other words, a half of 1%, if you're going to be looking for reversal patterns, okay, in that environment. Because there's no guarantee that you're going to time it perfectly, because you're still inside of a macro uptrend or downtrend based on the data you're looking at. So if you're looking at a net short position, 12-month extreme by the commercials, again, you got to remember, they're early, okay, and they have the deep pockets. They can absorb all that time of sitting in losing positions, okay, or drawdown. Because think about it. If they grow cocoa, they could be sitting in a net loss, okay, of a hedge, but they have the actual cocoa, okay? They actually have it. What's worth more, a transaction in the marketplace or actually having the commodity? Having the commodity, because that's real business. You can't make money, okay, telling someone here, I'm going to give you 100 shares of IBM. IBM, if I was on an island, I don't care about 100 shares of IBM. But if you have, 5,000 bushels of wheat or 10,000 bushels of, or bales of hay, okay, I'm not hay, but of wheat, I'm gonna be looking for, value in that, because I could use that. Shares don't mean anything, okay? There's intrinsic value associated by the actual commodity in hand. So they have the deep pockets to absorb all this. So don't go in there thinking just simply because the COT data is indicating there's a major reversal underway. It may take months for that thing to unfold and then finally turn around and start going lower. Okay, but it gives you the indication that, hey, look, don't be so wildly bullish now because everything's so against it fundamentally with the commercials. Be very short-term, nimble buyers in that environment as well. If you have a net short position, extreme, I'm very leery of betting a whole lot of money on trades that are net long in those environments. And again, same thing, much in the same vein that we talked about risking a whole lot less by being a reversal pattern trader, looking for tops in that environment. Same thing, cut your risk on the buys in that environment as well, and you'll avoid getting caught buying the one that really breaks down and starts to reversal altogether. So how do the commercials trade? Well, I'm going to give you this is basically the standard commercial accumulation phase. And as price, okay, depicted by this blue line here, this V, okay, on the left side of the chart, we start coming down. That's going to basically graphically depict a decline in price. Once price comes down to a low of some kind, finds support level, okay, or deemed value, okay, the commercials, okay, are done all their buying. And then what will happen is they start showing a profit release portion of the move where all of the selling is abated, and now the buying influence now comes underway, and there'll be an appreciation in price as price starts to rally up. All the accumulated buy positions they start to take, okay, in other words, as their positions that they bought as price was dropping lower and lower and lower, because they're hedging. As price drops, they buy more. As price drops, they buy more, they buy more, they buy more. And eventually when price stops going down because they've bought so much and there's no more selling, okay, all the sellers have been absorbed, okay, the long positions, okay, as price starts to move up, they start liquidating that, okay, and they offset their long positions, okay. So as a whole, not individually, okay, but as a whole, collectively, the commercial entities, okay, this is what causes the shifts in major macro price swings. Okay, you don't get this information from textbooks. You don't get this stuff from, you know, Larry Williams. I didn't talk about this level of it, but when you understand what's going on, as price drops, commercials are buying and buying and buying and buying and buying. Eventually, as price starts to move higher, they will liquidate those buy orders. Okay, and they're not trying to make astronomical amounts of money. All they did was hedge price. Okay, in other words, they were locking in a fair price that they felt that was fundamentally based on their collective understanding of what, you know, the supply and demand curve called for at that time. And once price gets back to those price levels, they can unwind that hedge. Okay, and that's all that trading is, really. If you look at the macro perspective on any asset class, that's what's going on. Okay, and that's how the smart money operates. So an intermediate term price swing looks like this overall. Now, during the accumulation phase, now obviously everything that we're showing here for a market low to be forming, reverse everything here that's graphically being depicted for a top to form, or intermediate term or long-term high. They would be selling as it goes up, and then would be buying it back as it starts to drop down. But every time that price comes to a point at which they would be selling, okay, there's going to be a retracement. And inside that retracement, that's where optimal trade entry comes in. That's where I have found a sweet spot, if you will, in trading inside these macro price moves. If you look at a daily chart, and if you look at a long-term or intermediate term price low, like this is graphically depicting, you could see clearly that the minor retracements that take place are absolutely stellar buying opportunities. But unfortunately, as price starts to move up like that, neophyte traders are in two categories. One, they don't think it's going to keep going up. It's probably going to go lower now because everything's you know, trying to find the top or trying to find the bottom. And the other camp is it's already moved too high, and I'm afraid that I don't want to buy it right now. So those two camps are the reason why the neophyte traders don't make money when the moves are really moving in the right direction. They don't trust directional premise. The basis to finding and consistently trading with a directional premise is to understand the macro trends. okay, the macro price swings on a monthly, weekly, and daily basis. Using commitment of traders, understanding price action, market structure as we discussed in previous video in this set, understanding how price moves in long-term, intermediate term, and short-term price swings, understanding where you're at in that market structure, where the probable direction may take us from current price action. That is going to be paramount for you to have your directional premise in mind. So we're going to assume for a moment that as this price action model or example here depicts, as price was dropping lower and they bought 4 large scale blocks, okay, as price dropped down. And obviously I don't have the insight to tell you how many blocks of longs they bought or whatever that asset class would be, okay, but I'm just giving you a graphic depiction of they were buying as it was going lower. As they were buying as it was going lower, the net long position on the commercials would be net, it would be above the basis line. Or if it's below the zero line, okay, in other words, showing a net short position, it would be dramatically being reduced. It still may not be net long basis to the zero basis line on your net zero position on your commitment traders graph, which I'll show you real examples of what that looks like. So if you're kind of like scratching your head saying, it still doesn't make any sense, trust me, it will in a few moments. But the COT data will indicate what we're showing here, okay, in the COT. In other words, the commercials will be dramatically lessening shorts or increasing to a net long position in a COT graph or chart. And once the price finds a support level and shows an indication that it has a willingness to bounce and trade higher, once that takes place and we have a market structure shift bullish, okay, as defined in previous videos, once we have that, we would now be looking for support to be respected and resistance to be violated and broken to the upside. That's how we work within market structure. And then every time we see a retracement, we don't anticipate the sky falling, okay, and everything going to hell. We are looking for new buying opportunities and looking for it to trade back into a previous existing order block bullishly, finding an old resistance now turning support, maintaining higher lows and higher highs. And then on a daily chart, if we start seeing institutional order flow that's measured with a coupling of 2 moving averages we're going to talk about, and in that case it would be the 18 and 40 exponential moving averages. Again, that's the 18 period exponential moving average and the 40 period exponential moving average on the daily chart. When the 18 crosses the 40, once it crosses that, we don't care about the crossing itself. We want to see it cross and then start opening up. When it opens up, that's called stacking. When that happens, that is measuring a very strong momentum, okay? And the way funds trade is momentum based. And one of the largest followed approaches to momentum trading is the 18 and 40 institutional moving averages. And to simply looking at the opening of those averages, okay, will give you the insight you need to follow the direction of both those averages. Once they cross and the 18 is above the 40 and they start widening, okay, and they're still pointing up, the diagonal of the direction of where they're trading is pointing up, and they're opening wider, the 18's widening above the 40, that's institutional sponsorship, graphically depicted in moving averages. That gives you the directional premise to focus in on, specifically waiting for retracements back down to a known support level or resistance broken, then turn support, going into a previous existing order block that's bullish, okay? And if you don't know what an order block is, look at my trading precision trading volumes 1, 2, and 3. It goes into great detail as what an order block is, an institutional order block. And that's simply what all you're going to be doing. You're going to be looking for those scenarios to pan out for your buying scenarios, okay? And it doesn't matter if you're a short-term trader or if you're a day trader or if you're a position trader. Every one of those asset approaches to trading, those will be complemented very well with this approach, and using institutional order flow, using commitment traders, fundamentally price action drivers behind why price should be expected to go higher, and You'll have everything that you need to build the directional premise model that you're looking for. Now the problem is there's going to be times when the averages on the 18 and 40 won't be crossed over, and price will be going up, and you're going to be wanting to send me email saying it's not working, something's not right, I missed that move. Guess what? There's a lot of moves I miss, and you're going to miss a lot of moves, but you don't need every move. Okay, if you looked at my net earnings based on what I do for over a whole year, you would be like, you know all this stuff and you trade that little? Yeah, but guess what? I took you to the bottom line of that a whole year. You'd be like, wow, this is a whole lot of nothing in terms of effort, but a huge reward in terms of the return. And that's what trading is. That's what professional trading is. I don't want to be a whole lot of time in front of the charts. I did that. You don't. Trust me. If you want to do that, you won't want to do it when you do it. Okay. You'll like living life and doing the things with your family. Now here is the key. This is the $1,000,000 secret, if you will. Okay. When you're looking at the COT graph or the Commitment Traders Report chart, basically it's plotting the net long and net short positions of both all three camps: the speculators on the small level, the large speculators or fund managers, and in the commercials. And every week it's updated. Okay, what you're looking for is the trend of the commercials. What are they doing? Okay, no, for instance, looking at the number one part of this crude depiction, I admit it's very crude, but it's still going to, it's going to accomplish the means. This number one point is going to represent a 12-month extreme net long position by the commercials. Okay, and what you should be doing is you should be reducing the risk on all of your new shorts, okay, or existing shorts, and anticipate a likelihood to find buying opportunities. The number 2 point in this graphic depiction, you can see the commercials move down to a net short position. This net short commercial position, okay, even though it's very, very small, okay, you can look for short to intermediate term downside corrections. Okay, but overall, look what we have. We have a very, very large pre-existing net long positions by the commercials at the number 1 point. So really, even though the price may correct and trade lower during that period of time that in May where we see a net short position by the commercials, that may be just a minor correction, okay, for the trend to resume during the number 3 point. Okay, number 3 is a new net long position. Now notice it's nowhere near the level of net long that the point 1 reference was. You see that? It doesn't matter, because you've established a trend change likely if you see it confirmed in price action. If point 1 in that period of time between February, March, and early April, if we have a bottom form in, say, the Canadian dollar, if we see that form, okay, price will rally, okay, and break market structure to the upside, and then it will retrace during the month of May during that net short position, okay, because they're going to sell into that rally. Then that rally, that initial rally, they're going to sell into that. Remember what we just talked about? They're unwinding that hedge that they put on place during the whole period of point 1. During that retracement of point 2, don't think that you're in a bear market. Stay focused on looking for net long positions, okay, for your own trading. So in the point 3, okay, after that 12-month net long position, you want to be looking for swings and position trades long. Your macro trend traders, long-term traders, looking for big moves. That's when it happens. When they move back to net long after a big, huge net long position. Okay, when they move to a net short, back up to a net long, that's when the best buying opportunities for position trading takes place. If you're a swing trader, it's an astronomical place to take entries for being a buyer. Point 4, again, they swing back down to a net short position. During this time, okay, you can still take short to intermediate term downside shorts, because it's basically going to be correcting again. It's going to be a retracement and an up move. Then at point 5, we have another net long position. Okay, the commercials went back above that 0 basis line. Notice they're nowhere near the level they were before net long, but it does not matter. This is like an oversold condition for you. Okay, you want to be looking at that saying, wow, this is now another buying opportunity because they have now bought some more, prices dipped down and retraced. So now what's going to take place is you're going to again look for short to intermediate term buying opportunities because you're trading with the COT trend. Okay, and at point 6 we see price come down and they make a huge net short position, the largest they've made in the last 12 months. What is that going to indicate? The likelihood of a high. So you want to be reducing the risk on your long positions and many times filtering out new buying opportunities and start looking for selling opportunities. Okay, but again, don't bet very large in terms of risk on those large net long positions and net short positions. You don't want to do that. It's the initial retracement later on after that extreme and price supports the notion that a major reversal is taking place. That's when you want to put your maximum leverage on, if at all. Now, obviously, the inner secret to commitment traders is to trade with the trend of commercial traders, okay, because they set in motion all of the intermediate term and long-term highs and lows in the marketplace. And you can find them by ferreting out the 12-month extremes in the net positions, short and long, by the commercials. So if you look at this as a macro understanding of fundamentals, okay, it gives you all of the things that you want to look for in terms of studying fundamental data, reports, bank reports, all that stuff. All that's ferreted out for you. And if you couple this information with support and resistance, astronomical results as a result for doing such. So now what does it look like graphically? Okay, and what I'm showing you here is a chart from pricecharts.com. Now before I say anything further, this is a paid service. You will have to pay for this, okay, to get this particular chart. You don't have to have this chart. I just simply like this chart. When you see my videos, I don't always share this format, okay, because I really print these charts out and really mark them up with pen. And yes, I still do that archaic way of doing it. Even with having computers, you have the yin yang here, I still like to mark up paper charts. That's how I started. I'm old school, so I'm a dinosaur. 20 years ago, we didn't have the wonderful things we have now. It's high-end technical traders. But if you don't want to use pricecharts.com and pay the money for their absolutely gorgeous charts, you can go on their website and try their 2-week free demo. Okay, and you just create an email address because they're going to spam you. Okay, I'm telling you up front, they're going to spam you, and you can try for 2 weeks for free and never use the email address again, and they can keep sending all their publications trying to get you to subscribe to an email address you never touch again. Or you can go to barchart.com and pull up the chart like we're going to show later on in this video how you can do it for free. And I know a lot of you are saying, yay, thank you, Michael, for free, but sometimes it's nice to pay a little bit of money. It's not a lot of money you would be getting as an expense to get this, but to me, if you do like to print them out, or if you'd like to have it electronic, it doesn't make a difference. I just like to have them in hard copy because I draw all kinds of notes all over them. But if you look down here, and we have the net short position and net long position and the zero basis line, and I'm going to show you that right here. This is the zero line. Follow that across the chart. Okay, see that right here? What this is indicating is the zero basis line. Anything above zero is net long, anything below it is net short. The commercials are the heaviest black line. That's this line right here. Okay, and you see what they have here? Large net long position, largest they had. And look down here, we have the commercials diametrically opposed to the large speculators. They're the funds. Okay, now notice what's going on here. As price had dropped in the euro, this long big trend going lower from 150 down to 120, that's 3,000 pips. Okay, 3,000 pips of a down move. Okay, the large speculators were pretty much with that whole trend all the way to the very end. The commercials were buying the whole way up. Okay, I'm sorry, on the way down, they were buying large numbers of net long position on the euro. Finally, when the euro came down to 120, the diametrically opposed tug of war, okay, the tide changed, price changed and moved higher, started trading higher, and then they got in sync with the now new bull move, okay, as the commercials started to liquidate their long positions. Who was assuming the other side of the long positions they're selling? The funds. Okay, you see how there's an interchange relationship between the two? As the commercials move higher, the funds start moving lower. This is one of the absolutely wonderful secrets, if you will, to how the dynamics of the marketplace work. And if you understand the relationship between these two, okay, it's a dance. Okay, it's a beautiful dance between two entities in the marketplace that absolutely give you every insight that you would absolutely love to know, but you probably didn't even know you needed to have this information. I mean, think about it. If you didn't see this before, you probably never, many of you probably never even knew this existed, let alone let it be free information. Okay, because the information's free. They have to buy. This is one thing the government did right. They forced large traders to tell us whether they're net long or net short. Now imagine if they could do that for stocks. I mean, that'd be wonderful. 401s would have no problem making money then, okay? So now looking at this example, okay, here we have the, like we were talking about earlier, we have a net long position by the commercials, okay? Net long, hugely net long, okay? And then eventually price starts to move higher. Then they swing down below net zero. So now they're bearish. They have a net short position. What do you think price should be doing at that point? It's going to correct. And you see that happen here. It comes down and corrects to what? An old support level. See this? Okay, price comes down to that price level. Now also look very closely. You'll see price moving up aggressively and then trading all the way back, coming back inside of that range right there. Okay, you see that? This is optimal trade entry. This is the classic ICT entry pattern. Okay. If you were an indicator driven trader, if you looked for oversold bullish divergence scenarios in this environment right in here, you would have hugely popular results in terms of success being a buyer at that time point. Okay, that's when your indicators work. And also notice once we got back down to this level, wouldn't you know it, the commercials were now net long. So now they're reassuming another long position. So the trend, if you will, is in a bull market, and you want to be in sync with them. So here they are, they're net long. The large speculators, or the funds, they're short here. Okay, they rode this little bit of a move down. Now it's time to get in gear with the move higher again, resume the primary macro trend higher. The commercials establish new longs in here. Price should be rallying. As it rallies, they unwind that hedge, and as they drop it off in here, who's buying the other side of it? The large funds, until we get to a diametrically opposed position again. When we have this extreme, the largest net short position in the last 12 months, there should be a high forming. There's your high. Now, price comes back up to an old level of support resistance. We have a price move from this high down to this low. Right in here, if you look at the weekly chart, as we discussed in the precision trading set, we talked about weekly order blocks, you'll see price in this example comes right up to that price point. Okay, and then that's when it gives you the high based on the fundamental drivers in the COT data, and we start to move lower and resume the downtrend. Okay, because we have another net short position extreme by the commercials. Okay, so that's a graphic depiction, if you will, of the trend of the commercials or commitment of traders and commercials and how they move. But look at this example here. Okay, this is what gets a lot of folks disgruntled with the use of commitment of traders. Looking at where we are, just simply over, are we above or below the zero line? That's not enough. You have to have price action included with the understanding. Because if you're looking at this example here, you can clearly see that there was a diametrically opposed position between the two. Net shorts held by commercials and net longs held by the large speculators. So common sense should tell us that we should be expecting a high to form. But look what takes place. These are weekly candles, okay? There's roughly 3 months, okay, or so, before the actual high was formed, and then starts to see the euro start trading down. So that's what I'm trying to explain to you. It's not just simply having the net short position or net long positions of the commercials. Okay, that's not enough. You have to have support and resistance. You have to have market structure. You have to have all those facets together to complement your analysis and not just simply putting everything on one tool. Now, looking obviously at the net long position here held by the commercials, when you see that, if you have been selling and you've been bearish, okay, looking for new shorts should again start weaning back the amount of risk on your shorts, and start expecting some level of rejection around higher level support and resistance levels. Now, I don't have the charts in this example, but if you go out to historical charts and you look at the 120 level, it's very indicative of a key support level. And when price came down to that level, and if you just recently saw in the last year or so, we were calling the market to trade around that same level again, and that was the low of the year last year. So when you see that, in video on YouTube, on the Inner Circle Trader YouTube channel, you can see it's there. I mean, it was called in advance, and here it is, and it was basically using the information that I'm showing you here. Understanding again the idea of support resistance is the central tenet to why this works. Not just simply are the commercials net long or net short. You want to be looking at support resistance. You want to be looking at market structure. Are we in a overall bullish or bearish market environment? Are we making higher highs, higher lows? Are we making lower lows and lower highs? Have we broken significant resistance and then has it turned to support? And now is the commercials signifying that there's a major trend change underway? Okay, as we see here in the year 2009, around April and June time period, all of a sudden that low, formed, and it had an astronomical opportunity to capture a huge amount of pips. Same thing can be said here when we have this extreme level net short position. You're probably thinking, well, I don't have a lot of time to be waiting around for these yearly moves here. Okay, these net long extremes, I don't have time for that. Well, that's wonderful. Okay, you don't have to have time. All you need to know is where we're at in terms of the trend, okay, and you can get in sync with that. If we see that there's a heavy net short position here, we don't have to have the bets highly leveraged, okay, that we're going to see the high form in this euro market. Okay, we would expect it to break down, then try to rally again, kind of like in here. See, price broke down, took out an old low, rallied again, and failed. If you look at optimal trade entry concepts, this is your entry point right in here. This is what you would be looking for. Then when you break down below the low that this formed, this is when you have a very clear shift in market structure or break in structure. Then the low that's anchored to this high here retraces, and then you're another optimal trade entry right in here, and boom, you have a nice sell-off. Okay, several hundred pips again made available to you. That's what this concept teaches you. It doesn't give you the 50 pip trades. Okay, it doesn't give you the 120 pip weekly ranges. Okay, it gives you the 500 plus pip moves to 1,000 pips. Okay, that's the type of trades that it sets up. Now, looking again at this area here where we went short by the commercials, okay, there's a lot of money to be made just trading inside of this, but keeping the perspective in mind, knowing that, okay, we just came out of a net long position that's extreme. We're retracing. If we come back down to these levels here of support at around 130, see how it bounced off of that level there? Okay, we had some resistance there, and it did violate a little bit, okay, but generally, you see the bounce here. When we traded back down to that 130 level and commercials were net long, with the backdrop of this net long position extreme, you have to have this in mind that this could be a very explosive move coming off of that 130 level. Simply utilizing the market structure shift that took place here. See, I have a high, and then it blew through it right there. Okay, we have a market structure shift, comes back down to known resistance broken. Now support with commercials on the backside of a neck long position by the commercials. Man, that's like candy. That's candy. And these set up 1 to 2 times a year. That's where you hunt. That's what you want to be. The 90% of your time looking and studying at price, you're looking for these scenarios here. Okay, you're looking for them because once you identify that, look at how much time you have when the trend starts moving. When you're in these consolidations like this and like this in here, okay, and down in here, you have to be a harmonic trader. Okay, during consolidations, when the market's in trading ranges, that's when harmonic trading is ideal. That's when you make money with harmonics, trading crabs and Gartleys and such. Okay, but the way you make astronomical, explosive profits, okay, and risk to reward is astronomical, is when you catch these types of moves here. You put the trade on with very, very low risk, and you let them run. Okay, these are what I call mega trades. Okay, I kind of dubbed that back in the late 90s, where you look for one or two big moves a year, and you 90% of your study time is based on that. And if you look at the work over the last 4 years that I've been doing with Forex on the internet, all of the major moves has been pretty much called by me in advance. And I'm not trying to beat my chest and brag, okay, but asking around, and there's not a whole lot of people that can do that and have it be documented as well. All right, so now we're going to focus in on this net long position here. When we see this environment, what do you look for? Well, I like to look for a combination of things. Obviously, I want to see a market structure shift on a intraday basis, okay, because you're going to see the trend change on an intraday level before you see it clearly on the weekly and daily. Okay, it's going to happen on the intraday levels first. But what happens is many times folks are spending too much time on the intraday basis and not spending enough time where we are on a macro level as it relates to the intraday. Okay, so in other words, they put way too much emphasis on the intraday. When we get to these environments like this, then I'm very, very keen on knowing what the intraday levels look like around the 5 and 15 minute and 1 hour basis, because if we're trading at these price levels and around time of day and we start seeing explosive moves up, I'm going to be looking for that retracement. Okay, I'm going to be looking for bullish harmonic patterns. I'm going to be looking for optimal trade entries. I'm going to be looking for bullish reflection pattern, ICT reflections. I'm going to be looking for the open of the days near the low, okay, and very minor moves from the opening down and then exploding up to close high on the day. That's the environment I'm looking for. If I start seeing that unfold on the daily ranges, I know I probably got a tiger by the tail. And if I can get an intraday pullback on an hourly or 4-hour basis and catch an optimal trade entry, based on like a big figure number or a mid figure or an institutional level, based on that initial pop, because you want to buy the first return. When we see that big surge up and it starts to retrace, I'm going to be testing the waters and trying to catch that first return from where we came from at that 120 level. It may not get right back down to that 120 level. In fact, I don't want to go down to the 120 level. I want to see it blast off and then try to fill in the expansion of the recent price action. Once it retraces back into an existing order block on a lower time frame, I'd be looking to be a buyer there. And then whatever market profits I can acquire during that initial move, that's what I'll use as a buffer to allow me to take initial longs on the swing setup like we would have in here, right in here. So if I can make money down here on this move in here, okay, if I get a bounce in here, whatever profits I have initially, I'm going to use that to maximize the leverage, okay, when I get the scenario here, because this is the trend following event where we'll see the explosive portion of the trend and the longest portion of the trend unfold right in here. Okay, and we're going to look at an example of the Canadian dollar later on, exactly what I did this year. All right, this is what it looks like on a Forex chart. Okay, same thing. All we're doing is looking at the data in a Forex platform. And this is, at the time, this was actually done with an FXCM. I don't trade with FXCM at the moment, but this is that charting platform that was used. And you can see the price did make the low here, just like it did in the commodity market, and price rallied up. And then here's that retracement back down into an existing order block, rallied up, retraced, optimal trade entry, and then boom, for the trend continuation. Here's where the commercials were net long, wildly net long, and here's where they move back to a net long position, and then all of a sudden it took off. A lot of money to be made right there. Lots and lots of money to be made in something like that. Now, right in here, this scenario, okay, much like we had described down here, I would be looking for very similar types of events. I'd be looking for, if you're an indicator-based trader like MACD or something like that, you could be looking for bullish divergence. You could be looking for trades to set up with the Judas swing. In other words, if price trades initially intraday lower for the day, I would expect price to make the low of the day first and then rally up. I could be expected to find ICT reflection patterns, bullish harmonic patterns, okay? But the problem, okay, harmonic traders have is they'll be taking profits way too early, okay? Because yes, we're inside of an ideal range environment for harmonic trading, but they'll cut their profits short, not understanding where we are on the macro level perspective, and they'll cheat themselves all of the existing potential profits that's made available, and by doing that, it kills in my opinion, it kills the necessity to be just a harmonic trader. Even though I have harmonic skills in my trading, I'm not quote unquote a harmonic trader. I am a dynamic trader, and I understand market profiling. So when you understand how to profile a market, you can work within any market environment and be able to reap profits. So looking at this, we can actually see a turtle soup, which is a false break below an old low, quick rejection. Now think about it. Price had rallied up here, came down and bounced. Where would the funds and trend traders, okay, that were lucky enough to buy down here, or maybe even down here or here, where would they now immediately move their stop loss to? Right below here, right? So watch what happens. Price rallies and comes back down, takes out these stops. Why would they do that? Why would price come all the way back down here just to come down just below this area, quickly run it and rally away? Because these stops are going to be what? Sell stops. Sell stops, when they're triggered at market price right here, when price comes down here and hits that level here, all of the pending orders down here become what? Market orders. To do what? To sell. Why? Because they're net long in here. So if they're trying to protect their position, they want to sell out of it because they don't want to lose any money, okay, or maybe lose some of the profits. What will happen is the price will come down, trigger those pending orders. The sell stop becomes a market order to sell at market. Who's going to buy at market? The smart money. So they knock these guys out of they're completely off the bus now, and they assume their seat right before the bus takes off and heads to the destination they wanted to be part of, down here, here, and here. So when we start to see rejections and raids on liquidity pools right below old lows, I love seeing that. 90% of the best moves take place with this environment right in here. Okay. Now here's a wonderful thing. This is a daily chart. If you see the reaction like this, come down here, take that out and reject, you can now look for the environment where the market opens and trades lower initially for the day. Buy that. Buy that initial low moving off of the opening. Okay, during the London session. The London session is going to create the low of the day, typically in that environment. And you'll see the market rally up, close high on the day. And then you'll see that phenomenon unfold as we move higher. Okay, but with minor retracements as we go along. Every time the price it retraces, okay, it comes back to an order block, okay, or comes back to an old support. A resistance broken, turn 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 support. Each one of those environments is an opportunity for you to be a buyer using directional premise. There's no rocket science to it. It's just a matter of looking for a combination of ingredients and then following the recipe to get blue ribbon results. And it takes some effort, guys. It's not simply a magic wand where you wave it in front of your screen and there's going to be a neon sign, okay? Or I'm not going to be on here every day tweeting, hey, look, it's a buy day, or this is the day you buy. Don't look to me as an oracle. I'm not that. I am an educator. I'm trying to teach you how to do this for yourself. I've been doing it for 20 years. I know this stuff works. It makes lots and lots and lots of money. And you don't need to do a whole lot to make a lot of money. All right, so now looking at, again, the price action that takes place here right before this. This is an optimal trade entry. Okay, so if you run your fibs across this price action, you would see this take place. The main thing I really want you to understand is what makes this optimal is that it comes back and fills this range, okay, from the low to the high, right before it takes off, this explosive move. This is what is indicative of institutional order flow. This is only going to occur when there's going to be institutional sponsorship. People that have lots and lots and lots of money at their disposal, and they're putting it to work by buying this currency. And when it rallies up like this, okay, it has to cool down, just like we saw in the commitment of traders. They went net short, and that's why you see this retracement. What did they do? Again, they went to a net long position. So they started buying more aggressively right in here, and they accumulated even more of the positions made through liquidity by running out the old low here. Notice there was no other low taken out prior. This is the one that's going to cause the exponential surge higher in price. When you see that in a move up, you see this, you like to trade the A to B, C to D, price projections, okay? When you see this phenomenon, this is what is the telltale signature point. And guess what? No one else teaches that. Nobody on the internet teaches that. But this is the perfect scenario to justify when an ABCD extension, okay, a price swing, when that takes place, this is what's there always. Okay? Put that in your notes. Every ABCD extension or price swing or measured move always has this in it. Every single one of them. When it comes down, blows out a low in an existing price swing up, this is when you know it's going to happen. When it violates and rejects, that's it. You know you're going to get an extension. What do you mean by that? Well, watch this. Take the low to this high. See that range from this low to high? When this thing rallies up, it's going to do this same measured move from this low to high off the low. And you can see the range from this low to high is duplicated from this low to this high. So now you know how to do a confirmation, if you will, of one of the quote-unquote basic harmonic patterns that no one else teaches. All right, now obviously it sounds like it's so easy you can't wait to get out and start looking at commitment traders and start making lots of money, but I want you to understand it's not always as clear as we would hope. Many times it's simply understanding, are we reducing net shorts or are we reducing net longs? It doesn't necessarily have to be a net long or net short position that tells us something. And that's when another tool needs to come into play. And that's going to be the tool of open interest. When we see price action like this, where the commercials are already net long, okay, but they were coming out of their net long positions aggressively, and then they added aggressively right here. This is indicative, okay, of a buy. This is supporting a buy, okay? They are, yes, net long, but they have been aggressively coming off of net longs. But when they see this buying surge again in here, that happens to occur right here. When we come back down to this swing, this low in here, when we look at price coming down to these levels in here, we're going to find support. It's justified by them increasing net long positions, and you see price taking off, okay? It's not, again, it's not indicative of easy winnings by simply looking at the net short, and net long positions by the commercial. That's not enough. You need to have a little bit of perspective, if you will. If, for instance, I'll give you this. If the commercials are heavily net short, okay, if they're heavily net short, that would be, viewed as they have a fundamental reason to expect lower prices soon. Sometime soon, they expect fundamentally that the price should not go much higher, and it should be a retracement of some sort, or altogether a reversal. But if they aggressively change gears, okay, and they don't think that there is a likelihood of the move occurring on the time scale that they thought, they may aggressively change their net position, okay, and that is useful, okay, because you can see that here we have a net overall net short position. They're net short here, but then look what they do. They rapidly reduce their net short position right before the big move takes place out of this consolidation. Inside of this move right in here, if you looked at open interest, which we'll talk more about in a little bit, open interest decline. I know this for a fact because I have the information. I was looking at trading opportunities back then. Looking at this in here, you'll see open interest decline. Open interest is only going to decline if commercials are covering shorts rapidly, because they are the market entity that creates the markets for us in the futures market. So if they are the largest net short or seller in the marketplace, they have a real reason to be selling in them because they're hedging. If they are rapidly reducing their net short position, that's telling you something fundamentally, that they don't think it's going to go lower immediately soon. They expect a sizable move, and wouldn't you know it, 1,000 pip move ensues before it starts to take a turn of events and makes it go lower. Now, again, going back to this in here, okay, it's important that you understand that there is a lot of swing trades available throughout the year by using this information. This is a daily chart. These are all daily candles. When you see price surge like this initially, okay, and starts to retrace, you want to be focusing on support and resistance. You want to be looking for order blocks, okay, which will be the last bearish candle before the big move, okay. That's where the smart money accumulates in down moves, okay. As we discussed how the commercials trade in the large macro span of price swings, the same thing happens on a daily chart. On down days, that's when they accumulate longs. Okay, how many times have you looked at a stock chart? Have you looked at an indice, okay, or a currency, and we had a real big washout day, big 200 pip down day, and the very next day it rockets up 150. The next day continues on, and it never turns around. They accumulated long positions during those down days. You need to think like a smart trader, okay? And smart traders are what we dub as smart money. Smart money buys when price is dropping. You have to get that in your mind, and don't be afraid. You need to grow comfortable buying when price is screaming going lower. And I know it sounds like it doesn't make any bit of sense, but that's exactly what works. Okay, you want to be trading in the opposite direction you want to see a profit in. All right, so basically, as it relates to commitment of traders, you need to stop listening to the herd. Okay, in other words, the forums, people telling you, oh, I'm buying this, I'm buying that. The guys that had the most popular YouTube channel, the most subscribers, yada, yada, yada. These guys don't know what they're doing. They talk a good game, but they have no idea what they're doing. The way you stay informed is you want to be focusing in on the smart money. And here's the wonderful thing. They make the information available for free. You want to trade in the direction of the most recent 12-month commercial net position. You want to wait for price to form intermediate term swings. Use optimal trade entry patterns to enter and trade with the large traders. Now again, that's not the commercials. The large traders are those long-term trend following traders, okay? They are going to be assuming the other side of the liquidation of the hedges that the commercial traders absorb and accumulate during these big price swings. You want to filter out longs when commitment traders reaches a fresh 12-month and or 4-year extreme on the commercial net short position. Now think about that. You're getting rid of the necessity to feel like you're going to make $1 million on a long position when fundamentally it's not likely to happen. That's wealth making insight right there. You want to filter out shorts when the commitment of traders reaches fresh 12-month or 4-year extremes on commercial net long positions. All we did was reverse the scenario. When we see commitment of traders reaching a 12-month or 4-year extreme in net long positions, you want to be filtering your short positions and reducing risk. Not to say you can't day trade and sell. You can't. I'm not saying you don't have opportunity to be a seller still, but you just have to be mindful that anytime soon there's going to be a major upset of that downtrend, and it's going to be aggressive. Many times it unfolds very aggressively. You want to trade with the COT trend engineered by the commercials. You want to look for seasonal tendencies that line up with the net readings of what you see in price action, and by doing that, you're going to have the framework for remarkable trade setups. Now, for more information on commitment to traders, obviously, two resources that I think are really good are the Commitments to Traders Bible by Stephen Breese and Trading Stocks and Commodities with the Insiders, The Secrets of the COT Report by Larry Williams. And I don't have it listed here, but I always talk about it every time I talk about books. If you don't have Larry Williams' How I Made $1 Million Trading Commodities Last Year book, again, it was a 1970s book, and it's still absolutely timely today. The information as it relates to commercials in there and open interest is what I'm discussing here. Okay. And I think it's one of the absolute gems in technical analysis that honestly, a lot of people read his book. A lot of people know about commitment traders. A lot of people know what open interest is, but not a lot of people actually use it, because if they did, they'd be wildly successful. So going forward, if you find yourself another resource that provides commitment to traders resources and you think it's useful to the subscribers to my work, obviously I would love to have a heads up about it. Again, we talked about using barchart.com, and you see me using barchart.com in my videos, but I mentioned in here pricecharts.com, and I think that to me, I think barchart is just as good as pricecharts.com, if not better, because it's free and it allows the subscribers to my material to do it without having any kind of paid resources. And I know a lot of you guys are on short budgets, but eventually at some point you might want to avail yourself some resources and spend a little bit of money, and there's nothing wrong with that. But if you find something that's comparable to the ones I suggested in here, just share it with me, and I'll share it with subscribers and pass that insight on to others. Okay, how to capture explosive Forex profits. Now, I know this is exactly what everybody wants to know, right? All right, Michael, how do I make money? This is great. We're talking about a lot of theory here. You're boring me to death. How do I make money? How do I get in the marketplace and find these big moves? Okay, you're showing the stuff in hindsight, but how do I look for it going ahead? Well, understand this. One of the biggest money makers that I have is trading with the weekly range. And the weekly range is one of the absolutely beautiful scenarios where you get the lines portion of the weekly range. And ideally, you want to be buying very near the weekly low. And you want to be able to absorb the time required to hold on to the position until late Thursday and even as late as Friday's close. There's a little study I made a lot of folks do when I initially put out this information in 2010. I asked everyone to simply look at the weekly range over a 15-minute chart. In other words, compress your 15-minute chart and delineate the days. That way it gives you a vertical line delineating when the days begin and end. And I want you to notice the reoccurring pattern that takes place. And I know many folks, that have been trading for a long period of time, I've had commented in email saying, well, it's pretty obvious, isn't it? Well, my question is this: if it's so obvious, did you use the information to trade the weekly range on a consistent basis? Were you able to use the information and use it to facilitate a trading plan? And they never replied with any information to the effect that they did. So what I'm suggesting to you is this: go into your charts and go for the next couple weeks. Okay, I'm going to show you how, if you focus on the monthly, weekly, and daily, and you arrive at a premise to directional bias on COT data, the 1840 moving average concept that we just discussed, and we'll talk more about in a little bit here. If you look at when it's positioned to move higher or expected to be bullish, if you look at the activity on a weekly chart, or a weekly basis rather, over a whole week time span, and it's easy to see it on like a 15-minute time frame, compress it so you have the whole Sunday to Friday's close, you'll see that the weekly high in a bearish environment typically forms around Tuesday's London open session. And many times, if it's going to be a down week, it'll form no later than Wednesday's London open. There is a 70 to 80% chance of that phenomenon taking place. Again, if it's a bearish environment, you're expected to see lower prices because the overall macro trend is bearish. What will happen is Sunday's opening will open, and Monday's trading will generally be consolidation, and then it'll start to move up. Okay, and what happens is all the neophyte traders start thinking this is going to be the next big move up, so they start buying and buying and buying and buying. And then on Tuesday, okay, what will happen is during the Asian session, Monday into Tuesday, there'll be more consolidation, and then what will happen is they'll ramp it up real aggressively up, and that's what we call a Judas swing, okay, or it's like a fake out, or what I just recently dubbed it for those that make fun of the Judas swing's name. It's the open rally sell down close. Okay, so it's an open rally sell. Okay, so in other words, you're looking for an opening, looking at midnight in New York time, the initial move up at that time point, going into the London Open session around 3 o'clock in the morning in New York time. Generally between 2 o'clock in the morning and 4 o'clock in the morning New York time, in that environment, the high of the day will form. Now, if it happens to be on a Tuesday or Wednesday's London Open, you have an 80% chance that that's going to be the weekly high. Don't take my word on it. Go through your charts and study it. Okay, and I'm telling you, I know what's going to happen. I'm going to get 300 to 400 emails again saying, I can't believe it's been there all this time. Yeah, you're right. It's been there all this time, and again, nobody talks about it, but ICT. In bullish environments, okay, what will happen is the market will open on Sunday, consolidate, or trade lower on Monday, and then Tuesday it'll consolidate, and then there'll be a rapid decline going into Tuesday's London Open, or between 2 o'clock and 4 o'clock in the morning on the East Coast New York time. Okay, when you have that window of opportunity, that's the ICT London Open kill zone. The opportunity is to expect the weekly low to form on Tuesday's London Open or as late as Wednesday's London Open. Now, you're probably saying, okay, well, that's wonderful, but it's still not 100%. You don't need 100%. Okay, if you have the macro view in line and expecting, the directional premise to be one direction or another based on what we've discussed so far, you have a lot of the battle already won for you. Now you're just going to fine tune it down to, okay, well, if the market's predisposed to move higher, and that means that the market should be closing up on the week, so the range from the opening on Sunday to close on Friday ideally should be an up move. So where it's principle should suggest that Friday's close should be higher than the price that was traded on Sunday, right? Okay, well, how do we get to that? There's got to be a low form first, right? Many times what will happen is they engineer the early beginnings of the week to go lower, and a lot of times that fake out sucks in a lot of neophyte traders. And if you watch the forums, many times they buy it hook, line, and sinker, and they chase prices going lower, and then they get shell shocked when they reverse it dramatically, and they drag them across the whole entire weekly range. Okay, folks, we're looking at the Canadian dollars as a weekly chart, and I want to show you what it looks like in an example that just recently happened. We have the red line here. This is the commercials, and the way you get this chart on your this is barchart.com, by the way. You go down to the bottom of the page once you load a chart up, click indicator, and you're going to add this one right here, the commitment of traders line chart. Okay, that's what you want. You can make it small, medium, large. It's small right now. I don't need it any larger than it is. And I got 5 years on it. So going back, you can see that this is the largest net long position that the commercials has had in the last 4 years. Okay, it was above the one that we have here. And price traded down to it's like the 89 level, almost the 88 level. Big figure. If you go out to a higher time frame, which I'm not going to do here just for time constraints, it is a major support level. We have a net long position, and we see price drive lower but fail to go lower and then rallied up, breaking market structure highs in here. So now everything is bullish. We would expect to see retracements and moving higher, going up. Before we go any further, I want you to take a look at this low here, the lows over here, and this low here. Okay, and how price went right to 94 and traded off of that. I called 94 back here, okay, and I called 94 back here as well, and it's all on YouTube and on videos that were shared through Twitter, so you can go back and take a look at all that stuff. It's not hindsight. I want you to take a look at this purple line here as well, because we're going to look at this. This is open interest, and as it relates to how all this stuff fits together. But for right now, as price traded lower, the accumulation of the longs held by the commercials indicated there was possibly a reversal underway. Looking at the daily chart, we have our 18 and 40 day EMAs. The green is the 40 and the red is the 18 day, as noted here, exponential moving average. And I have the open interest. Again, open interest can be found by adding it here, or by simply having total volume. You want to have total volume, not contract volume. You want total volume on. Okay, I have 9 months on here. You can do whatever you want to do to have as much data you want to show. But looking at what we have, this was the low. In other words, it violated this little consolidation here, rejected, ran out and higher, broke market structure in here, and retraced back to an old resistance, now turned support. Then rallied again. Okay, came back, found support at old resistance, broken, turned support. Rally through. Now we're coming back down to an area of old resistance, should act as support. Old lows back here, it blew through those. Okay, but now I want to go back and take a look at a few things. We have a consolidation in here. Open interest declined rapidly. Remember when we talked about open interest? Open interest declines rapidly only when the commercials are rapidly covering their short selling. Why would they do that? Because they think bullish prices are underway. Also, we have a consolidation in here in an existing bullish environment. See, the 18 is above the 40. We have a retracement, many optimal trade entry opportunities in here. But remember I talked about right before we see a measurable move, you'll see a stop run. Here's a low. Market comes down below the low, blows it out. And then what do we see? The expansion on the upside. Notwithstanding that during this consolidation, we also have another drive down in open interest, which we talked about in video before the fact, and we saw prices rally up to what level? The 94 figure. Now, this is a 500 pip move, all based on the information that we just discussed in this particular video. I promise you that if you go through your charts, study them well, you'll see a couple of these form a year. Not a million, not one every month, okay, but you have one or two major moves set up like this. But you can trade in sync with them. Once you have the directional premise in mind, like, see, we crossed over here on the averages, but then later on we started seeing the averages open up. Okay, the averages are opened here all the way through all this. You can day trade this long with the open drop down initially in London, rally off of that and close higher. Okay, all that's being seen here. You can also find retracements, okay, for optimal trade entries, all in this move. Once the average is crossed over here, you wait for the retracement, and then the next move up should open the averages, and you start seeing stacking. This is stacking when all the averages open up. Much in the same vein that this is stacking on the lower side. The 18 was below the 40, and you would just continuously look for selling opportunities while that condition exists. Okay, so I counsel you guys to really just spend a lot of time with the higher time frames, because it gives you the backbone, okay, to hold on to a directional premise, because you are in sync with the higher time frame smart money. All right, the swing trade. Okay, we talked about the 1840 averages, how it looks, what you do with it on the charts, and how the COT data is useful in that respect. Okay, but what is it? What does the swing trade look like conceptually? What are you doing? How does it work? How do we confirm the setups? Is there something that we can do to build the confidence factor behind the trades? Well, there just happens to be something that I use in my trading that helps me do that. We're going to be looking at the ICT swing trading method. Now, what sets up an ICT swing? Okay, well, there's a concept that I released in 2009, and I actually posted this in the forums on forexmentor.com. Yes, forexmentor.com. Now, forexmentor.com, okay, obviously is one of the widely known educating for profit websites out there, and I think pretty much everyone knows about them. But I, I have bought just about everything that they have put out, with the exception of Peter Bain's stuff. I did get his Big Dogs course, and really it's not much at all. The the insight, okay, that I shared about this concept is the SMT divergence. Okay, and I get a lot of questions about what is SMT divergence, and all it is it's a little abbreviated term that I came up with for smart money tool. And smart money tool, okay, is basically looking at correlated market asset classes, okay, or groups, okay, to arrive at a underpinnings based on the actions of smart money. Okay, so think about this: if we can agree on the mechanics of the markets moving by those that have a lot more money than us, if we can agree on that, okay, and I think it should be a very easy thing for us to agree on. In other words, the market's only going to move by that entity or entities that have a lot more money than us. If we are able to agree on that, you have to understand something. They are motivated by greed, either not to lose money or to make money. Either way you cut it, it's still greed. Now, because they are driven by greed, they will be emotionally okay, charged humans just like us. Okay, the guys that are managing those hedges, okay, and they're assuming those positions, they're human beings just like us, and they're prone to make mistakes. They're going to buy more than they should, or they're going to sell more than they should. Now think about this: if we understand that an asset class is closely correlated, and I'll give you an example. If you look at the stock averages, okay, and the idea behind the SMT, it really comes from the Dow theory. Okay, there's really no magic to it. I just used something I understood very clearly with the Dow, and it was really amplified with Larry Williams' How to Select Stocks for Immediate Gains book, a real old book. Okay, the only thing that was useful in the book to me was how he looked at when the Dow made a lower low, but stocks didn't make a lower low, and then once the stock market as a whole started to trade higher, the issues that didn't make lower lows, they're the ones that smart money was accumulating. Otherwise, they would have made lower lows too, but they didn't. They were being accumulated. So I used that premise along with the whole general premise behind Dow theory. The averages should confirm themselves, okay? And when they don't confirm themselves, that is a telltale sign that there's someone with a lot more money than us working behind the scenes. Okay, so you can see the underpinnings of the market on a smart money basis that no one talks about. Okay, so where this phenomenon takes place is every quarter there's a shift in institutional flows, and by using old highs and lows, okay, focusing in on SMT divergence on a daily chart will ferret out many of the trade scenarios that you're looking for. Okay, you want the sizable price swings to work inside of, whether you're a scalper, a day trader, a swing trader, a short-term trader, or looking to position a long-term trade. This is how it's done. Okay, you're going to use market structure, and you're going to be referencing swing point analysis. You're going to just use simply the optimal trade entry for your strategy to get in the trade, but you're going to use swing projection for your profit objectives and determine where you're going to get out at. All right, SMT swings on a daily chart. What is it and what does it look like? Well, we're going to say, for instance, that this is the dollar. Okay, the green represents the greenback. Okay, and we're going to say that the red represents the British pound or cable. Now, the problem with this is going to be this. Because there's an inversion, okay, ideally, if the dollar's rallying, British pound USD will be declining. That's the mechanics behind it all. That's usually what you see. For us to see how this works easily, and it's easier for your eye, okay, you have to have a way of inverting one or the other. Either invert the dollar or you have to invert the cable. In other words, you're going to have to mirror one. So that way they'll be moving in tandem. Okay. And the insight is going to be gleaned by looking for periods of when price between the two. Okay. You can see how the red, again, obviously we're using as an example of being the cable, was able to make a lower low here. The dollar was not willing to make a lower low. That is SMT divergence. It's a crack in correlation. They should have made comparable lows. See how they were trading together lower here, both declining? Right in here, the dollar was saying, I'm not going lower. Okay, when the cable, okay, we're assuming it's being mirrored here, this would have been the cable making a higher high. And it may be a little bit confusing, so this is the reason why I got to watch the video several times. But if the dollar makes a failure swing to go lower when the cable makes a higher high, or in this case, if we mirrored the two, if it makes a lower low, that's an SMT divergence. That's a crack in correlation, and expect to see a major move the other way. Okay. Same thing happening here. We have price making a lower low in here, and the cable was not making a comparable low. It was actually a little bit higher in here. We have a divergence, SMT divergence. We also see that same thing happening on a larger scale. See this low comparable to this low? This low represents this low. The cable went lower here. The dollar was not willing to do so. Now you see a price swing. Okay, price moves higher here in the cable, was unable to do it here. Okay, and when I say higher here in the cable, again, this is assuming it's being mirrored like it is. So this would be a lower low when the dollar made a failure swing to go higher. Okay, and I know it's a little bit confusing, but basically a higher high in dollar should be met with a lower low in cable. A lower low in the dollar should be met with a higher high in cable. Okay, so every low and high should be equal in terms of breaking to higher or lower ground between the two. If you don't see that happening, there is a break in correlation. Okay, you see the high here? We made a higher high here in the dollar. Look what was going on here. Again, this would be the cable mirrored, so this would be lows in the cable. The cable was unwilling to make a lower low, or in this case, since it's being mirrored, it was unable to make a higher high, when the dollar was able to make a higher high. So what is that saying? While the dollar was able to rally, the cable was actually being distributed. Smart money was selling that whole thing right here. Every time it was making a rally, they were selling it aggressively, and then boom. Okay, I said that wrong. I just realized that this would be actually buying the cable because it's inverted. So they were unwilling to go lower in the cable, graphically depicted here as not being able to go higher. So the dollar, when it starts to sell off, we'll see an extrapolated move on the cable going higher because it was unwilling to make a lower low. So again, this high to high on the dollar was higher. That should have been met with a low and a lower low in the cable here. Again, this is mirrored. Okay, this is actually, this whole price action here should be reversed. But for us to compare highs to highs and lows to lows, you have to mirror one or the other. Now, I used to teach it where I didn't mirror it, and it just was so confusing for a lot of folks that it was very frustrating for them. And this is probably doing the same thing to some of you now watching it. You're thinking, wait a minute, I thought I understood it, now I don't. It's really not that hard of a concept. Again, watch the video several times and you'll get what I'm talking about. When we see the examples, it'll make much more sense. The dollar here failed to make a lower low when the cable on this chart here made lower lows, which would have been a higher high in actual price of cable. Crack in correlation, expected price move to the upside. And really, that's all you're looking for. Every 3 months or so, inside of 3 months, there's going to be a crack in the correlation, and all you're doing is looking to find that scenario, that selection tool. Okay, it's not a timing tool, it's a selection tool. You're looking at the daily chart to frame the idea that there should be institutional sponsorship on the buy side or the sell side, and by seeing that, you get yourself in sync with looking for the anticipatory move of price going lower or higher based on this insight, and then using intraday entries and price patterns around that, or with support and resistance. Now, assuming we have the scenario where price has now set up a SMT divergence on the bearish side of things, well, you would expect price to rally up into a level of higher time frame resistance. What is that? That's a monthly resistance, a weekly resistance, or a daily resistance. Okay. Once price shows a clear indication that it is wanting to move away from that resistance level, now you have a commitment on the smart monies. In other words, if you're looking at this, think about it. Graphically, this would look like a retracement for a buy. If you were just looking at price and thinking without a higher time frame premise in mind, and if overall premise was bearish, this would look like a buy signal. And I just gave this example at the time of this recording. The previous week of this recording, I gave examples of how the charts looked like buy scenarios when it was still underneath an institutional sell. But this is what you're looking for. You want to see it break down and start to rally back up to that resistance level. When it does that, that's where you sell it. Then once you enter the short, you want to see the market break down and take out the previous swing lows. Once that thing breaks that low, now you're going to be looking for that A to B to C to D measured move phenomenon. Okay, and what will happen is there'll be a retracement of some sort very soon after that. Inside of this retracement, it can come back to the old low, or what you're looking for is you want to see that stop running event. You want to see a short-term high in here that's ran out. Okay, that's really not clearly shown in this. I'm really graphically oversimplifying this, I'm afraid, but inside of this rally in here, okay, this would be a period of time that would encapsulate a previous swing high that's eventually ran again. Once it does that, that's the stop rate that you want to see, and that's when the big move starts to take place and runs down, and you have the measured move phenomenon, or the A to B to C to D extensions. When you have that measured move of this low to high, that range projected from this low down, that's one objective. Or you can take the range of this low to high and do a 127 extension here, or 1.618 or 1.62 extension. That's how I just rounded up. Use that example, okay, and couple that with the A to B to C to D extension harmonically. And that is the easiest way that you can get in sync with the trend, trade with the commercials, with the smart money, trade with a pattern-based method using support and resistance, only higher time frame, monthly, weekly, and daily support and resistance levels in mind. Many times what will happen is this area here will be an order block. Over here, this high that's not being depicted here, this will be a bearish order block, and price will return right back into that area and sell off again. Okay, and that's the basis for building a very sound approach to higher time frame trading. And once you understand how this is done, all the intraday action of selling in a down day, that's all this is. The same thing being applied on an intraday basis. What will happen eventually is you'll go into consolidation, and everyone will now start chasing the move lower, but the move's already happened and you've already profited